What's up guys, it's Nathan here. In this video, we're going to analyze predictions from experts from the top banks around Australia and discuss the possibility of further rate hikes, cuts, and the potential effects on the housing market in 2023 and beyond. The home loan market in Australia has experienced some sharp rate hikes over the last 12 months as the Reserve Bank has been trying to rein in inflation. Experts from the top four banks of Australia, Westpac, NAB, ANZ and Commonwealth Bank, have varying views on whether interest rates will continue to rise or when they might decrease. The Reserve Bank of Australia has expressed a tightening bias, but in more recent times has softened its language. The big banks suggest that rate cuts may not be too far off as the economy recovers from disruptive influences. However, the predictions are divided. All four major banks accurately predicted the two rate rises we saw both in February and March of this year, but had differing views on the April rate pause and also the surprise rate hike in May. The current debate revolves around whether the cash rate has peaked at 3.85% or if there could be one last rate hike this year, potentially bringing the cash rate officially to 4.1%. Although headline inflation has slowed from previous months, it remains high and is a concern for the Reserve Bank. Philip Lowe, the governor of the Reserve Bank of Australia, has stated that additional rate hikes may be necessary to control inflation using monetary policy and the cash rate. The pace and extent of future rate hikes will depend on conflicting economic indicators, including spendings, property prices, and overseas market conditions. Only Commonwealth Bank of Australia correctly predicted that the May cash rate of 3.85%, while the other banks expected another rate hold. Commonwealth believes that at 3.85%, we've peaked in terms of the cash rate, while Westpac and NAB foresee that there might be a potential rate hike in either July or August of this year. Effectively, will be at the peak at the 4.1%. Mortgage stress will continue to impact the housing market as the tightening cycle progresses, and borrowers will eagerly be awaiting stability or reductions in their cash rate. And if you find value in this video, please consider hitting that subscribe button as it really does help out the channel. And a big thank you to all our subscribers for your support. Inspires us to create more content we hope you enjoy. Now, regarding rate cuts or a recession in 2023, the Reserve Bank will hold off on raising rates if inflation gets under control or if the economy slows down too much. In the event of a recession, the Reserve Bank may actually choose to cut the cash rate to stimulate the economy and alleviate the burden on mortgage holders. Whilst there's no certainty of an economic downturn, the risk remains, especially since inflation has been driven more by supply side disruptions than consumer demand. However, with strong employment, relatively high consumer spending, and the calming in global disruptions, the risk of a recession appears low. The banks estimate that inflationary pressures will ease off by late 2023 and early 2024, potentially leading to the Reserve Bank of Australia to relax its grip on the cash rate and implement some rate cuts. Commonwealth Bank of Australia predicts that cash rate cuts might start in the last quarter of 2023, whilst Westpac anticipates easing from 2024, providing some relief for borrowers. Overall, borrowers will closely monitor the Reserve Bank's future decisions as the cash rate rests currently at 3.85%. We have had a bunch of clients ask us recently if it's worthwhile fixing, and I guess it really depends. I mean, based on some of these bank predictions, it might not make sense to fix, but having said that, we've heard time and time again the bank saying that we're nearly at the cash rate peak, and then they revise their forecast. So I guess if you are looking at fixing, some of the things to consider are: what is your financial situation? Are you currently struggling with repayments? If you'd like stability in repayments, and that's where a fixed rate can be great for those that are really struggling at the moment, in that you know exactly what your repayments are going to be for a set period of time. You don't need to be really too concerned if these predictions do change, which we've seen in the past. We've seen the major banks consistently say we're nearly there, and then revise their forecasts. And we don't need to look back all that much. I'm talking 6 months ago where the big banks were actually predicting a lower cash rate and a terminal peak. So as new data comes in, we might find that these estimates are actually incorrect and the rates might need to go higher, or they might actually need to come back down. I guess no one really knows is the key. So I think if you are worried about rates and you're not too sure where things are going to go, I mean, we can take a little bit of solace from the big banks' predictions, but I wouldn't be holding our breath on it. So fixing in will give you that stability. If you are worried about repayments, you want some stability, looking at a 12-month fixed rate or even a 2-year fixed rate might give you that peace of mind. I guess the flip side of fixing in is that if those predictions do come right and rates start to come back down, you might lock in at 5.39, 5.49% as of today. And if rates start to come back down, you got to remember that you're going to be locked into those rates. So it's one of those things you need to weigh up both sides. No one really has a crystal ball. So I think you've got to do what's right for you. And there's no one size fits all approach. And this is where you need to be careful to make sure you get your cues based on your own position and not what others are doing. So in some circumstances, your friend might be fixing, and for yourself, you might go, well, I've got a bit of cash flow free. And this is where you need to make a decision on your own individual circumstances and take into account all the little ifs, buts, and maybes that are things that might be of your own concern, and try not to take too many external factors in making your decision, such as your friends saying, yes, you should fix, or looking at some of these predictions where they're saying rates are going to cut, because some of it or all of it or none of it could come right. And that's where you might be in a troublesome position because you've listened to a prediction here by some of the banks, which maybe doesn't come through. And now rates are going up and you are struggling. So this is where you need to make that decision based on your own individual circumstances. As a mortgage broker here at Hunter Galloway, this is something that we go into depth with our clients and have a conversation and really trying to challenge the thought process to make sure you're making the right decision. Because ultimately, you only really got to know if fixing in now or not fixing in now is the right decision when you look back in hindsight, because as I said, these are just predictions and even the banks get it wrong. Thanks for watching today, guys. Here at Hunter Galloway, we're a mortgage broker that deal with people Australia-wide. So if you're looking for assistance, feel free to reach out with us directly. There's no cost for the service and you can contact us on 1300 088 065 or visit our website huntergalloway.com.au and fill in a contact form. Guys, as always, thanks for watching. We'd love to know your thoughts down below. Leave a comment and we'll see you next time.